Did you know that two UK businesses, both making just over £50,000 in profit, could end up with completely different tax bills? Yeah, one might pay thousands more than the other, all because of a hidden rule they just didn't see coming. Well, today, using an expert guide for one of the UK's top firms, Pro Tax Accountant, we're going to make sure you're not one of them as we get into corporation tax marginal rates for 2026.
So picture this. You've worked relentlessly all year, and you finally pushed your company's profit past that £50,000 mark. It's a huge milestone, right? A proper sign of success. But for so many business owners, that moment of celebration is quickly followed by this sinking feeling of dread, like you're about to run headfirst into a tax wall. Let's talk about why that is.
And this really gets to the heart of it. The fear is that your tax rate just suddenly leaps from a manageable 19% straight up to the main rate of 25%. Ouch. But the reality, well, it's actually much fairer than that. The system's designed to be a gradual increase. Think of it less like a cliff you fall off and more like a gentle ramp you walk up. Understanding that difference is the key, and that's exactly what we're going to unpack.
Okay, so here's our game plan. First, we'll tackle that 50K profit problem head-on. Then we'll explain the tax bridge that actually solves it. After that, and you'll definitely want to stick around for this bit, we'll cover two major traps that catch so many people out. Then we'll look at what happens when your business gets large, and we'll finish up with some smart planning tips for 2026 and your next steps. Right, let's get into it.
Right, let's kick things off with the problem itself. Your business is growing, you're hitting your targets, but that amazing success can very quickly feel like a new kind of headache when you look at the UK's corporation tax system for the 2025 to 2026 tax year.
So here's the deal, and it seems simple at first. If your company's taxable profits are £50,000 or less, you pay the 19% small profits rate. Easy. If your profits are over $250,000, you pay the 25% main rate. But what about that massive gap in the middle? That little question mark? That's where all the confusion, and honestly, all the anxiety, lives for thousands of growing UK businesses.
But that question mark is there for a very good reason. And that reason is a system called marginal relief. You should really think of it as your tax bridge. It's specifically designed to get you from that low rate to the high rate safely, making sure your tax goes up gradually, not in one sudden painful jump.
So in plain English, what does this actually mean? It means as your profits climb from that £50,000 mark up towards that upper limit, your effective tax rate slowly, and I mean slowly, creeps up from 19% towards 25%. It's a much fairer, more sensible way to tax growing businesses. It prevents a sudden shock to your cash flow just as you're starting to scale up.
So let's lock in the first number that every single growing UK business owner needs to know. £50,000. This is your lower profits limit. Think of it as the ceiling for that nice, comfortable 19% rate. The second your profits hit £50,001, you've stepped onto that tax bridge. This number is your starting line.
And here's the second number you have to burn into your brain. £250,000. This is the upper profits limit. Once your profits fly past this line, the tax bridge ends. You are now firmly in what HMRC considers large company territory for tax, and you're paying the full 25% main rate. The entire system we're talking about today, it all happens between these two goalposts.
Okay, theory's great, but let's make this real. Imagine a small creative agency in Manchester. They've had a brilliant year, made £150,000 in taxable profit. So first, we calculate the tax at the full 25% rate. That gives us £37,500. Next, we work out the relief amount using that formula you see. That gives us £1,500 in relief. And finally, you just subtract that relief from the main tax figure for a final bill of £36,000.
And this is the magic of it, really. The company's effective tax rate isn't 19% and it isn't 25%, it's 24%. It's a blended rate. And that £1,500 difference, that's real money that stays in the business. For that agency in Manchester, £1,500 is a new laptop, or a software subscription for the team, or even a small marketing campaign. That's how marginal relief actually works to support growth, not punish it.
Now, if it was all that simple, nobody would ever get it wrong. But stay with me, because this next part is absolutely critical. This is where a lot of people stumble. There are two major hidden traps that can catch out even the most switched-on business owners, and they can lead to some really costly mistakes and nasty, unexpected bills from HMRC.
This is the first and maybe the most important question. An associated company is basically another company that you or the same group of people control. If the answer to this is yes, or even just a maybe, then all the rules we've just talked about change dramatically. This catches so many people out.
Right, let's make this super visual. For one single, standalone company, you get the full £250,000 upper limit and the £50,000 lower limit. Everything is exactly as we've said. Nice and clean.
But look what happens the moment you have an associated company. Those limits, they don't apply to each company individually. They get shared between them. That £250,000 upper limit is suddenly sliced in half to just £125,000. And your lower limit is also halved, down to £25,000. You hit that main 25% rate much, much sooner.
And if you have 4 associated companies, the limits are divided by 4. Your upper limit just plummets to £62,500. Suddenly, a company with £70,000 profit, which thought it was safely on that tax bridge, is now paying the full 25% rate. The key takeaway is this: the limits are shared between all of them.
And here's a massive pro tip straight from the team at Pro Tax Accountant. A mistake they see all the time is people forgetting about dormant companies. You might have registered a company name years ago for a project that never took off. If that company still exists on the company's house register, even if it's doing absolutely nothing, it still counts in this calculation. It still reduces your threshold. It's a tiny oversight that can cost you thousands.
Okay, let's move on to the second big trap. This one often catches out brand new businesses in their first year, or any company that changes its accounting year end. If your accounting period isn't a full 12 months, those limits we talked about are reduced proportionally. So, a new startup in Birmingham that only traded for 6 months in its first financial period will have its lower limit halved to £25,000 and its upper limit cut down to £125,000.
Okay, so we've covered the rules for small and growing businesses, but what happens when your company really starts to scale? Let's have a look at what happens when your business becomes what HMRC defines as large, because this changes not just how much tax you pay, but fundamentally when you pay it.
And here is the third big number every ambitious business owner should have on their radar: £1.5 million. Once your annual profits get past this threshold, your company is generally considered large. This triggers a completely different payment regime, and believe me, it has a major impact on your cash flow forecasting. You don't just pay your tax in one lump sum after your year end anymore.
Instead, you have to start paying your estimated tax bill in 4 quarterly installments during and after your accounting year. As you can see from this timeline, the first payment is due just over halfway through your financial year. This means you are literally paying tax on profits you haven't necessarily even received as cash yet, which requires a much more disciplined approach to your finances.
So, we've covered all the rules and the traps, but this isn't just about avoiding mistakes. This is about taking control. This is where we learn how to turn tax from a reactive chore into a proactive, strategic part of your business.
Knowing these thresholds allows you to make much smarter decisions. For example, if your profit forecast shows you're landing just a tiny bit over that £250,000 upper limit, you could maybe bring forward the purchase of new equipment that you needed anyway. That spending reduces your taxable profit, potentially pulling you back onto the marginal relief bridge and saving you tax. The same idea applies to strategically timing a director's bonus or making a larger pension contribution. It's not about avoiding tax, it's about timing your activities in the most efficient way.
Right, let's bring all of this together. We've covered a lot of ground, so let's just nail down the most important points and figure out what you should do next with all this powerful information.
If you only remember 3 things from today, please make it these. 1. Marginal relief is your friend. It's a supportive bridge, not a punitive cliff. 2. Always be aware of those 2 big traps: associated companies and short accounting periods, because they will shrink your thresholds. And 3. This knowledge is power. It lets you move from being a passive taxpayer to a strategic business plan.
Now, it is absolutely crucial to say that this is for general guidance. Every single business is unique, and the rules, especially around associated companies, can get incredibly complex. So please do not rely on this for your financial decisions. Always get professional advice that is tailored to your exact situation.
And for that kind of tailored advice, you can get in touch with the experts behind this guide, Pro Tax Accountant. Their details are right there on the screen. You can reach them on WhatsApp or by phone at 07985 689912. Or you can drop an email to info@protaxaccountant.co.uk. They can look at your specific circumstances and give you the clear guidance you need. And for a more detailed breakdown of everything we've talked about today, you can read the full article on the Pro Tax Accountant blog. And for more essential guides just like this one, make sure you subscribe to their YouTube channel. Thanks so much for your time.